half of our clients, while they may even have a US based entity, end up being, or at least having, a distribution of networks that are either in the Cayman BVI structure, or have a Swiss foundation, or are based out in Singapore. So we're constantly dealing with these issues of intellectual property between entities across different jurisdictions, or even the full transfer of that IP. And if you get that wrong, you're on the hook for some fairly significant tax consequences if the governing body comes in and says, well, no, actually, the valuation of this should be significantly higher. You want to get the valuation as close to when that transfer is happening, and then you limit kind of the usage of that, just to protect not only yourself as kind of being the responsible party when you're on the hook for taxes and all of that. And certainly we defend all our reports, but we limit to 30 days for anything at this stage.
Welcome to the Accountant Quiz, where we help accounting and finance professionals learn how to manage a business using crypto. In practice, token launches are often delayed, which can slow down the whole roadmap of a Web3 project. Once there is a traded price for a token, it's very hard to get away from that price, and post-launch valuation would be magnitudes higher than a pre-launch valuation. That's because a token valuation report has a limited shelf life. In Web3, valuation is critical and can impact everything from legal structuring and tax reporting to hiring and compensation. On today's episode, we're diving deep into token launch and valuation, and we'll go through setting up token grants, how to determine the fair market value of a token pre-launch, M&As in Web3, and financial reporting. And joining me is Neil Thakur, Managing Director and founding member at Teknos Associates. For the past 10 years, Teknos Associates has specialized in providing valuation and advisory services to clients in Web3 and has developed industry-leading valuation methodologies and best practices. Some of their clients include A16Z, Aave, Chainlink, Filecoin, Optimism, Aptos, DYDX, Eigenlayer, Solana Labs, and more. If you're currently navigating the tedious process of a token launch and trying to make sense of your SAFT with your lawyers, tax advisors, or other service providers, this episode could avoid you some costly mistakes. Lastly, if you're new to this channel, I'd really appreciate your support to help us grow by liking this video and subscribing. Now enjoy my conversation with Neil. Neil, welcome and thanks for being here.
Thanks so much for having me. I really appreciate it, Umar.
I want to start the episode today, Neil, with the topic of valuation. So Web3 projects, for Web3 projects, valuation, it becomes a key concern at different stages, both before and after token launch. And typically during this process, these projects would engage with a range of service providers like the lawyers, the accountants, the tax advisors, and third-party valuation specialists like yourself. So I want to ask you if you could walk us through what a token valuation actually involves and highlight maybe the moments when founders should start to pay close attention to some valuation issues.
Perfect. Yeah, there's a lot of components to kind of unpack there. And I think, some of the critical points in time that we usually start speaking with folks are, well, candidly, as early as possible, right? The few moments of critical kind of mass in all of this analysis is making sure that you get to this process where, if this in fact is for something that's, call it compensation related, you want to get this done prior to any potential pricing moment on the token. Now, and what I mean by that is either selling the rights to tokens via SAFT, maybe there's a commercial deal we were promising tokens at a certain FDV, or it's part of any sort of deal where you're implying a value for the tokens. And the problem with that, well, it's great from a capital raising perspective, or just kind of an understanding of the market for the token. The downside is actually, it comes into play when you're actually distributing these tokens or the rights to these tokens to founders or early individuals who are part of the project, where they're maybe getting this token as a form of compensation in exchange, right, for different things. Now, one way to get around all of that, or it's not really get around all of it, but to safeguard yourself on any potential significant tax issues is is to get a valuation prior to any of those pricing events. And when you do that, you can justify that, the token may not have as much value at the early stages, right? Because there's risk components to the network launching. The token usually isn't minted yet or is about to be minted, but the network isn't live. So, while you may have a positive kind of focus around where the value is going to be at some point, the reality is that the token in of itself at the early stage can potentially have very little or nominal value. And the way we get into that in terms of how we to value that token or the project in of itself is centered around some concepts that we take from the equity world, right? When a company is originally formed, you look at things from potentially a liquidation value, right? There hasn't been a financing round, and it's more aspirational in terms of what the value could look like. But if I'm really just forming an entity, a lot of times I can look at it at a value what we call just par, right? It's just several fractions of a cent. And the way we justify that in the token world at very early stages, one very common methodology is to look at what we call kind of a liquidation / cost based analysis. Similar for some folks who are familiar with IP, like a cost plus approach, where you look at what's been put forth towards the development of that particular asset at that point in time. And, you can even carve out and really around kind of areas of focus of the token, right? What's been put forth towards the development of the token versus the entire network. Because a lot of times in the entire network, when I'm applying that to just the overall kind of value of the ecosystem, there are a lot of things that are built on top of that, depending what kind of project it is, right? So, early stage projects can have, products and services built off of the efforts that are put forth towards the development of the token project, but the token in of itself, the actual tokens like utility and value can be even further separated from that, because that's just one component of that. And so when you look at that and you look at early stages of what it costs to put that token together, usually if there hasn't been any kind of pricing mechanism and there's enough distance between when the token is actually going to launch on the network, or maybe there's going to be a potential liquidity event around that in the future, you can still make the argument that there's not a lot of value in that token. And so when you consider that there's time between when this token is going to launch, the risk factors associated with that, and then maybe there's lockups on top of that, you can get to a value that's on the lower side, and you can utilize that when you're transferring the rights to these tokens to founders and other individuals that are going to receive that. One of the critical things here, though, is making sure that, again, that there are no kind of potential indications of value around that token. So we like to see as much distance as we can between when you make those distributions of the tokens and, again, that pricing event. And so we like to say, at least 45 to 60 days, because given the volatility in this market, as what's true today isn't necessarily going to be true tomorrow, a few weeks from now, and someone could argue a few minutes from now. So anyway, those are a few different things like at early stages that we look at. That's probably the most kind of basic and fundamental way, but it's really about like the factors that are surrounding the ability to use that methodology that really come into play here. So that's why just getting to this and talking to people as early as possible on it is very critical at the end of the day. But hopefully that gives a little bit of a sense of kind of how the things we look at. And there's certainly several other methodologies that come into play, but at the early stages, that's how we look at it. And then as we move forward in the process, we can certainly address some of those other types of methodologies.
When you were saying 45 to 60 days, what were you referring there? And can I ask you, what is like the typical shelf life of that token valuation report?
Yeah, so there's a lot of different perspectives on this. If we take an analogy to, the equity world, a lot of times in some more traditional analyses, you almost have a year or a material event, whatever comes sooner. Material event could be like, a financing round or something that's actually implying a value for that asset. A lot of traditional worlds will say, hey, you have a lot more time on the valuation. We take the perspective, just having done this so long and understanding the volatility of the world, that we live in on this, we have a very limited shelf life on the valuations that we prepare, as opposed to probably most, just as we're cognizant of how your regulatory bodies may look at this or anyone else who's reviewing this. You want to get the valuation as close to when that transfer is happening, and then you limit kind of the usage of that just to protect, not only yourself as kind of being the responsible party when you're on the hook for taxes and all of that. And certainly we defend all our reports, so we limit to 30 days for anything that is at this stage. It's actually shorter in other certain circumstances where it can be 15 days or shorter if the token is live and it's trading, because obviously there's movements around that token. So it's harder to support that value in those instances for longer periods of time. But we limit that shelf life specifically for that period. And if there's also another reason around it, there's use cases in the US that we see, something called an 83B election. We can get into that, but the filing of that needs to be done within 30 days of the token grant. And so it also kind of aligns with that concept as well, right? You've got a regulatory body who's suggesting that there's a limited time that you have to file for this particular use case. So it aligns with that pretty well in addition to that.
Thanks for sharing. So we'll speak more about the 83B election later, and we'll also speak about token valuation methodologies. But before this topic, I want to go through around setting up multi-jurisdictional entity structures and their associated IP valuation and any transfer pricing issues that can arise. So when a project starts to build in Web3, it usually starts with a simple legal entity like a DevCo. But as the project goes, and teams would often then think about setting up foundations or DAOs like that manage the protocol. And that usually involves transferring IP or intellectual property. For the listeners, IP in Web3 would typically relate to things like smart contracts code, white papers, patents, domain names. So if those intercompany transfers are mispriced, especially undervalued, it can trigger tax consequences. So I want to ask you, for projects who decide on setting up these international entity structures, could you walk us through potential valuation issues around these IP?
Yeah. So similar to other types of situations where you have a potential regulatory body looking at the transfer of property that goes across jurisdictions, be it tokens, IP, anything of that nature. Anytime you leave one jurisdiction and go to another, there's usually some sort of tax consequence. And so you referenced transfer pricing and IP kind of regulations that fall around that. We know that at least in the US and other jurisdictions around the world, because most of our clients are, let's say, half our clients, while they may even have a US-based entity, end up being, or at least having, a distribution of networks that are either in the Cayman BVI structure or have a Swiss foundation or are based out in Singapore. So we're constantly dealing with these issues of the licensing of intellectual property between entities across different jurisdictions, or even the full transfer of that IP. And if you get that wrong, you're on the hook for some fairly significant tax consequences. If the governing body comes in and says, well, no, actually, the valuation of this should be significantly higher because of whatever certain factors are in play at that point in time. So again, what happens is, similar on the token side, you try to get to this as soon as possible when the potential IP could be on a lower side, and you make that transfer at that time. Now, and I'm going to qualify this as we are not tax or legal professionals at the end of the day, and we rely on our partners in terms of how they structure these things. But in several circumstances, if I'm going to transfer IP, some of the assets that you pointed out can have a significant impact on their worth when they're transferred over, and the tax impact. And so when that's transferred over, we make sure that we get to it at a certain time, again, hopefully as early as possible, where the development of that assets is still at a very early stage. But the methodology is a little bit different. We can get into that in a second, depending on what's happened with the company. But yeah, at the end of the day, you're talking about tax hits anywhere from 25 to 50 to 75%, depending on how it's structured, and penalties associated with that. That's kind of inclusive of all that. So you don't want to open yourself on to that. We know that the regulatory bodies certainly are looking at this. And the thing is, when you're talking about the Web3 world and we're talking about the transfer of property, like some of this stuff is on chain, you can actually make reference to, what's being transferred, and then you can, reconcile that back to contracts. And so if you don't have supporting documentation that describes what the value of these are during that point in time, it could be very detrimental, at least when they transfer the IP. I mean, the other side of this too is when we'll see situations called like benchmarking analyses, and that's when we're talking about more like transfer pricing issues where you're licensing back technology amongst related parties. And so when you have that, again, making sure you're benchmarking like the rates that you're charging between two entities that could be considered related, or even if not, you want to make sure that they're done at an arm's length level. And so getting a valuation to justify that is certainly important.
So I have a follow-up question. We had Jonathan Turnham last week or 2 weeks ago on the pod from Nextlaw, and we were going through company structures, and he was saying that when like all these company structures, let's say the BVI, SPV, token vehicle, the Cayman Foundation, or the LabCo, these are separate entities.
Yeah.
So I want to ask you, like, in practice, like, can you give like a very, given like these are separate entities, like how does that transfer pricing issue relate to, because these entities are not actually related to one another, right?
Right. And so this is like the backstop of, there's a lot of discussion around this. I'll just say that, right? In reality, there's the reason we set up all these entities, right? And they are meant to operate kind of independently. And so, in that instance, usually you're fine. It is still, if you're transferring the IP, even though it's a separate entity, that initial transfer is where you want to make sure, because you have something leaving one entity, it's going to another. Now, even though it's not related, and that's a loose term here because the technology and everything that's run around this is hanging by a very kind of loose thread in the beginning, right? Because everything in theory is coming from the same place. But in spinning that out, right, that initial kind of movement outside, certainly whether or not it's related or not doesn't matter, right? Because you have something leaving one jurisdiction going to another jurisdiction. So, that concept in itself kind of comes into play. The backstop around, worrying about if they're related parties or not, I think this is more of a, call it belt and suspenders kind of perspective, right? We know that in theory, you're right, they are separate entities, but if someone were to make the argument that they are a little bit more closely related than normal, having something that justifies why the value is what it is from a benchmarking analysis is certainly very important on that case. And then there are situations where specifically where they are a little bit more related and vertically integrated in some situations. And so that's where, again, this is where, I would lean on our friends in the tax and legal world in terms of how they've structured it, where there may be, transfer pricing or benchmarking issues where they still need the valuation. But for the most part, it's, to your point, while they are separate entities, it's meant to still justify that transfer, that potential issue that could come up should someone question it.
Before we continue, let's take a quick commercial break from our sponsor. If you're serious about running your business using crypto, you need tools built for crypto. One of my favorite apps, and yes, one that I use multiple times a month, is Request Finance. This app has been a game changer in how I invoice my clients and receive stable coins and crypto directly in my wallet. But hey, there's so much more to it. Request Finance is the all-in-one platform for crypto operations. Accounts payable, accounts receivable, expenses, and even accounting. Plus, they've got a killer multi-pay off-ramp to over 190 countries, meaning you can pay someone with crypto and they get fiat in their bank account. Request Finance connects to over 20 blockchain networks, including Ethereum, Solana, Base, Arbitrum, Near, and more. Here are some features that I love. batch payments using your preferred wallet of choice, a single dashboard to track all invoices with real-time updates. All invoices contain the transaction hash for easy audits. But hey, don't take my word for it. Try that for yourself. Head over to requestfinance/partners/the accountant quits and get 2 months for free with all the pro account features. Join 3,000 finance leaders today using Request Finance and make crypto operations simpler, compliant, and less stressful. Correct. Now, I want to move on to token grants. So a lot of these projects working towards their token launch, they will also have some form of token incentive plan and token grant. So could you discuss how these token grants would typically work at this stage and maybe some of the issues that could arise around valuation?
Yeah, so we try to stay in our lane around just the valuation specific issues, and one of the things that I highlighted early on is getting to this prior to any events that could price the token, which could bring cause to adjust the valuation to something on a higher level. One of the other pitfalls that we see sometimes is when people put together commercial arrangements where it's not necessarily a financing arrangement in a traditional sense, but one pitfall is, hey, listen, we've got a network operator or another potential market maker, and we're going to run a deal with them where we're going to, in exchange for their services, we're going to promise them X amount of tokens at a certain valuation, if you will. And it's because nothing is officially kind of changed hands. There's the argument that, it doesn't really matter. Well, it kind of does, because you're implying a value for the token in that transfer, in that potential transfer that occur. And, you're going to be performing services in the meantime. And so because of that, there could potential concern around, us saying the value of this is next to nothing, but along the lines, you have agreed with certain partners that suggest that this could be worth something significantly more. And so, we see situations like that kind of arise at early stages sometimes when people are negotiating deals. And while they're not in the form of a typical kind of capital raise, there are other forms where, this can kind of apply. And so that's one kind of big thing that when I talk to a lot of early stage founders, which it's not necessarily intuitive around its impact and things that we see across the line. Other big things that we get asked about, and I think there's different schools of thought on how people approach this, but one common question is, does the token need to exist? When we do these distributions of token grants, does it have to be minted and then we do the transfer? I think the vast majority of folks usually say, depending on which lawyers you talk to, will say that the token itself, the property, if you will, has to exist for you to write the contract on it and be able to transfer that and show that there's something has been transferred. There are other folks that say actually the right to that token, or kind of like a prepaid forward contract, if you will, future token interest, if you will, that type of methodology is also fine. We as a valuation firm don't have a particular, call it, say on that. I'm indifferent towards that as a valuation person in general. There's value at something even though if it doesn't exist, right? The right to it, because there's efforts being put forth towards that asset. So the contract in of itself could even on itself have value. So it doesn't affect kind of how we look at it, but depending on the jurisdiction that you're involved with, the use case, particularly in the US, again, we'll get into what an 83B election is, but in that instance, people might make the argument that the token in of itself has to exist. So those are certain situations where we always like to make sure that, we're talking to the right partners on that, and we're making sure that our clients or potential clients are very well aware of the potential issues that can come up in those situations.
And what would be similar and different from common option grants there?
Yeah, so the common option grants are a little bit different, right, in terms of what you're transferring. A lot of times what you're trying to argue for the tokens, the closest thing on the token side to wouldn't say option grants, but transferring the actual asset in of itself is that 83B election, or actually transferring the actual property. When you talk about options, it's the right to the token or the right to equity in the future. So in the US, you have this thing called IRC 49A, right? And there's different kind of related financial reporting codes that sit with that, ASC 718, and then IFRS has their own kind of logic around financial reporting around this. And so there, what you're saying is you're setting kind of the fair market value of the asset at that time, but you're not actually receiving that asset right at that time. You are actually setting a strike price and then having that equal to the underlying value of that asset. And then you'll receive it in the future, right, when you exercise the option on that particular asset, and you pay taxes at different points in time. What we're talking about here is trying to justify the receipt of this property. Like, you're getting everything at once, right? There are restrictions associated with it because there'll be lockups, similar to like there's lockups and there's vesting, right? There's two separate concepts of things from a financial perspective, having a vesting as it's earned over time. The lockup is more of a technical restriction associated with the network. So two different things that are occurring, and tokens are different from equity in that instance by themselves. But what we're trying to justify at the early stages is that you're getting this entire property up front, in theory, and you're willing to pay the taxes on that because the value is at very low. Well, you can argue that the value is very low at that time. You don't mind paying taxes on something that's hopefully very nominal, and even though it has restrictions and you're receiving it later. In the equity world, and tokens can work in this way if you actually run a token option kind of contract, but a lot of people don't like doing that because once I receive the tokens at later stages, liquidity issues arise around maybe when I receive the token and having the ability to sell to cover taxes, et cetera. That can be a little more complicated versus the equity world. There's a little bit more clarity on how that equity is going to work. So, there's fundamental differences there between how people structure these types of transfers, especially at early stages. Now, when it gets to later stages, that we can certainly talk about that. But early stages, like the differential exists there in terms of how people structure it. But it's the difference between, say, arguing you're receiving this entire asset, even though it has restrictions and limitations on it today, versus the right to the asset and it actually being received in the future.
Speaking about structuring of these token grants, could you, for the listeners, provide maybe some sort of checklist of the first step that they'll have to do around probably the token would be created, minted, until that last step around filing that 83B election that you spoke of, but that is also very specific to the US.
Yeah, it's very US kind of focused, but if it's kind of the order of operations of things, and it can apply to other jurisdictions in terms of the justifications that are made around what's being received. But in terms of where we come into play, it is the valuation comes in, or probably I would say at least a draft of the valuation comes in prior to when you've got the entities. Well, I would say we do it in conjunction with when the entities are already set up, right? So, and depending on where you're going to issue the tokens from, right? If it's out of the foundation or the LabCo, there's different jurisdictions around that, but all that has to be set up right ahead of time. And then you want to make sure that you're teamed up with your law firms to make sure that the contracts are set up ahead of time as well, so that they can drop in our value. But you want to have all that set up, and then we prepare a valuation, and then on the heels of that, literally within the next couple of days, the tokens are minted, and then they're distributed to individuals or anyone who's receiving that. So it's kind of like this, making sure all the entities are set up, and then having the contracts kind of in place, and then we perform a valuation, and then at that point, utilize that valuation to drop into the contracts that are set, and they're distributed through different parties. And that's where you have your token cap table management guys and stuff like that who handle a lot of that distribution. There's a lot of moving parts to that, so that's certainly important. So getting that out there. And then if we're talking about an 83B election in the US, then you want to make sure once that document has been issued and the transfer has occurred, that's the clock that starts on the 30 days, right? And so you want to make sure you file that within that period of time as an individual on that side of things. And then I mentioned that kind of 45-day window, if you will. That starts from, and that's not, it's kind of related to all of this, but it's kind of the unofficial start of when you want that kind of, call it cool down period, right? So if I were transferring something today, you would ostensibly want to wait, around 45 days before you do anything with the token via pricing or it goes on an exchange or anything like that. We also recognize that, timelines slip in this industry quite often, and sometimes they can move up, right, depending on how the market's working. But when we put our valuation together, it's, what's knowable as of that point in time. So there's only so many things we can control when that exists, but it's just things to think about in terms of looking at the order of operations when you're doing actual token grants.
And for the listeners, when you mention these token cap table management tools, so you can check out tools like Liquify, Magna, Toku, TokenOps, all these tools like help you in that initial distribution stage.
Yeah.
So this next topic is specific only to the US jurisdiction, and it's the 83B election. So it's basically a tax strategy that's relevant to token grants that are subject to vesting. Can you explain what an 83B election is and why people choose to do them? And why it can be costly if you don't actually file it?
Yeah. And we've kind of alluded to elements of it throughout this conversation. But yeah, the large kind of idea here is that you are recognizing the value of this particular asset, but that it has to have restrictions associated with it. And usually it's kind of time lapsing restrictions, and it's barred from the equity world. People traditionally, when they're starting new companies with very minimal value, they're basically like a holding company, or it's just an idea around something and hasn't raised hasn't raised any capital usually, but it has very little value by way of just kind of thoughts around, IP, et cetera. A lot of times people will issue equity, and that's very different from issuing an option, right? This is actually, I'm getting my shares of the company at very early stages. And I alluded to it before around just calling something par value, and it's worth, fractions of a penny. And then, we pay taxes on, if I'm going to own 10% of the company, I'm getting 10% of that company today. And, it may have vesting provisions on it. Usually it has to have some sort of restriction along those lines of vesting. I'm going to get taxed on all that right now. And I don't mind that because there's not much to it on the value of it. And so we have the same concept. We've applied that concept to the token network and the tokens that will be received on that. So in this instance, same kind of concept. I'm going to receive tokens, some percentage of tokens in the network. And maybe as a founder, usually I receive a larger portion than most, right? It could be 1 or 2% of the network sometimes. And that's a big number. If I look at that number, what it would be traded at on the exchange versus what it is when it's first formed in terms of the token project in of itself. And so you'll have usually vesting restrictions associated. I alluded to lockups that could be on there, but the critical point is that you have these restrictions on there. And what I'm going to say is that I'm fine being taxed on the actual value of this today without those restrictions. What's the value of that look like, without the implied vesting restrictions on that? And again, in this early stage, it's important to get to it where there's no pricing events around it. And so then we can justify the value being low. And then I only pay taxes when I sell that asset in the future, and I get to take advantage of long-term capital gains taxes, right? And so in most jurisdictions, just not only the US, but most jurisdictions have separation between what we call ordinary income and long-term capital gains taxes, where you have the advantage of holding on to the asset, and those rates are different. If I don't do that, one of the difficult things that I have to deal with maybe as a founder or someone who's getting large blocks of tokens in the future, is that maybe I'll get a token option or something like that, and then as my tokens unlock at that first cliff, so they vest and unlock depending on how it's structured. And that first cliff, there's like maybe I get 25% of those tokens, and then monthly ratably thereafter. Every time I receive those tokens in the future, that's a taxable event, right? And so, depending on how the network has evolved, and we all want to be, if I'm a token project, the next kind of Solana, if you will, or a project of that significance with solid liquidity in the network. But the reality is, in the early stages of these projects, when they're still kind of getting going and the network's still getting built out, if I get a large portion of tokens, my ability to sell and cover the taxes into the market on that can be significantly difficult, right? If I have to receive, let's say at that point, it's like $1 million worth of tokens. But if I try to sell that $1 million worth of tokens in the market on that day, I could effectively depress the market significantly. And so, now I'm stuck with this issue of, trying to cover the taxes on a significant asset that I can't. And, there's a huge liability that comes into play. So now, and that's all at ordinary income, right? And so there are issues around that. Now, we're one of the few firms out there, I don't know who else does this, but we've come up with ideas to help in that situation, should that ever occur. And depending on kind of how the network works and the order books and depths of liquidity around the market, there are some strategies that you could argue that if I'm receiving a huge block of tokens and there's this effective slippage in the market, that the tax impact could be less, because you could argue that the fair market value of that token is worth less, because moving that significant block of tokens through the market could effectively depress the market. But we want to save you from trying to predict what that's going to be looking like in the future by doing this at very early stages, so that you only have to worry about it when you effectively sell the tokens and take advantage of the capital gains taxes.
So just to summarize it for the listeners, when filing the D3B election, let's say I receive my tokens when the value of that token was at $1, and 5 years later, when everything has been vested, it now sits, let's say, at $100. So my tax liability would be, if I file the D3B election, would be on the $1.
So yes, so the tax liability in the early stage would just be on that $1, right? And so I wouldn't pay taxes again until I actually sold the asset. Versus, so what's happening is I'm actually getting rights to that token in the future when it unlocks and everything. But I'm saying that I'm getting it all today. But you're exactly right. So I pay taxes on the dollar, and then when I receive it as it unlocks in the future, I don't worry about paying taxes at that point in time. Only if I sell it is when I pay taxes.
Cool. Next, I want to go through some of the methodologies that you use to determine that fair market value. So in many jurisdictions, crypto is treated as property for tax purposes. So if the company is distributing tokens in the form of grants or compensation, like we spoke of, they have to determine the fair market value. So to navigate this, companies often commission third-party token valuation services like yourself at Teknos. And a token valuation exercise basically would provide the documentation and substantiation of value required by the tax authorities when reviewing these token grants. Could you go through some of these methodologies that you use to determine the fair market value of a token pre-launch, and maybe some common pitfalls that you've seen that basically then could lead into like some unfavorable valuation results from a tax perspective?
Yeah, certainly. And again, we've touched on a couple of these kind of concepts, but yeah, we can dive deeper into them. But one of the most common ways that we try to look at these valuations at early stages is, again, that call it asset cost based type of approach, where you look at what has been put forth towards the development of the token project, and specifically the token in of itself. And at early stages, there isn't a lot of work that's been done at that early stage. And if effectively you have not priced the token in any other way, versus like via SAFT or some of the other things I alluded to, you can take that methodology where you start off with kind of the overall underlying token project in terms of expenses, call it sweat equity, like time, all of that, what's put forth towards that. And then you look at discounting methodologies where there are put option analyses where you look at implied discounts for lack of, call it, liquidity and marketability between the time of launch. And sometimes you throw in lockups as well. So if you extend this out to during periods, you have this asset for the entire network. You can get to a per token value based off the total supply, and then you can apply discounts associated with the time before the project it actually has any kind of utility. And so that is one of the more kind of mundane and basic approaches that we try to apply at early stages. The abilities to being able to do that. And so to your point around pitfalls, again, making sure that there's no pricing mechanisms or there's enough distance between when that valuation occurs and that transfer occurs, and again when you expect to launch and do some sort of exchange listing or something along those lines. Those are some of the bigger kind of pitfalls that we are always concerned with. As we get closer to launch, right, the methodology shift a little bit. We start looking at potentially token market caps in the space for similar projects, and it starts to be more of a blended approach where you look at potentially market caps or fully diluted values of similar tokens and call it a basket of tokens, and you can take a weighted average of that market cap and weight it against the, call it, cost to recreate approach as well. That starts getting utilized when we get in under that 30-day kind of time window of, like, if someone comes to us and they're going to launch very quickly, we have to start layering in the market impact. And then there's other market driven approaches where we can also look at potential sales in the market. If we have knowledge of OTC deals and stuff like that, we can take into account a lot of different market driven factors there, which are important in this industry just because there's so many moving parts. But once you get really close to a token launch, making sure you start layering those things are important. And then there's some issues where you might be able to build out, call it, long-term forecasting around the tokens themselves, running Monte Carlo simulations around, like, the price in of itself compared to different modeling exercises. But we tend not to rely upon anything like that until there's enough data to support that, just because in the equity world we can make a lot of assumptions and feel a little bit more confident about things versus here. Each one of these networks operates very differently, depending on whether it's an L1, L2, et cetera. There are different ways to look at that. And once you get beyond the scope of, like, having enough data to be able to support some of the assumptions that go into those models, it doesn't really prove something to be all that meaningful. So, it's usually a asset-driven approach in the beginning, a market-driven approach as we get closer to launch. And then once it's launched, I mentioned this before, but now you're dealing with the actual kind of trading mechanism around the token in of itself. So that's where we start diving into the order book and depth analysis of something, how it trades on an exchange, or if it's on a DEX, what the constant product model formula kind of looks like. And there it gets to be a little bit more of a sophisticated analysis around the token and how it works in a particular ecosystem. There's other methodologies that you can get into when you start forecasting kind of uptake and distribution of the token, and depending on the network, if it's a security token, stuff like that, where it might have claims to other types of revenue streams. And on that, there could be combinations of income approaches as well. But vastly, like the majority of our token projects in the early stages, we try to justify that call it cost-based approach, if you will.
Before we continue, let's take a quick commercial break to talk about something that every Web3 accountant, DAO operator, and finance professional can relate to: the chaos of on-chain data. Managing blockchain transactions can feel overwhelming when starting out. Fragmented wallets, scattered protocols, and endless spreadsheets that just don't add up. That's why I'm excited to tell you about our podcast sponsor, Octav. Here's how Octav can change the way you work. Under a single platform, Octav pulls together data from your wallets, custodians, and DeFi protocols, meaning you don't have to jump between tabs or apps. Also, you can instantly generate key metrics like wallet balances, protocol positions, and total funds by category or network. Everything's organized, clear, and ready when you need it. And lastly, if you need to share data with your team or accountant, you can export everything as a PDF or CSV in seconds. The best part? Octav doesn't just show you the numbers, it lets you add context with transaction notes and categories, making reconciliations, audits, and reporting a breeze. This isn't just about saving time, it's about taking control of your data so you can focus on what really matters, growing your Web3 organization. But hey, don't take my word for it, try it out for yourself. Head over to octav.fi/theaccountantquits and get 14 days for free with all their pro account features and discover how Octav can transform your crypto operations today. So what if people listening right now are realizing that they actually forgot to file this 83B election? Are there any other strategies to optimize for tax liabilities when the token is already live?
Yeah, and so this is the best case scenario. It's going to sound weird, but the best case scenario, if I didn't file my 83B election, is to look at the unlocking of the token as I'm receiving it in the future. And this is where we perform that, call it liquidity analysis or order book analysis, where the first batch of tokens that unlock, we would look at effectively what the implied fair market value would be if I were to move that entire block of tokens that I'm receiving through the network. And the hope there is that at early stages, there isn't a lot of liquidity in the network. And it's odd because in theory, we're launching these projects and, you want them to have a tremendous amount of uptake and movement and depth and all of that. But from a tax perspective, at early stages, it's far more beneficial if it takes a little bit more time for the network to ramp up and there's not a lot of depth in it. And so essentially what we'd say is, okay, well, I'm getting 1% of the network that's unlocking on today, for instance. And then I would go into the order books of the exchanges where this is being traded and to try to see effectively how far down do I have to go into this order book to liquidate this position. And commonly this is referred to as slippage, right, in the equity markets. And so there's an implied discount on the token in those situations. Now, I mean, we've seen situations where the block is large enough where it can be like a 90 plus discount on what it's trading at in the market. And in those situations, that could be a very beneficial solution around, okay, I missed my 83B election. I don't get this for fractions of a penny, but I would be protected at least on the receipt of the tokens and not being taxed at, if it's trading at $10, I'd rather pay taxes on a significant discount on that if I can, and getting a valuation from us usually helps justify that. And we do that in a fair amount of circumstances.
I also have a topic on working with high net worth individuals. So some of the listeners, they will be working with high net worth individuals. What are some of the unique valuation considerations that they could have for these clients when it comes to donations and stuff?
Yeah, so pretty commonly, and there are some providers out there that help structure those now at earlier stages, but and usually it's like estate and gift tax lawyers who help put that together. But again, similar to the equity world, you are taking these assets and maybe you're putting into a trust, right? Or some sort of vehicle that is tax protected or sheltered, if you will. But upon that transfer, you need a valuation to support that. And so along the lines of when we're doing this for an 83B election, a lot of times very shortly thereafter, people will take the assets that they received and move them into a trust for either their family members or other individuals or entities, if you will. And by moving them over there, like there's tax benefits to doing that. So as that asset kind of grows in that entity, it's shielded from any kind of issues on the tax perspective. So we find ourselves doing a lot of work there for a lot of the founders who are getting significant portions of tokens, and depending on kind of different stages of when that's being transferred, there's different valuations that need to be performed with all of that. I'll say that other things that we deal with for individuals, at that level, in addition to kind of gift and estate, is anytime there's, they're moving kind of jurisdictions, we're starting to see this a lot where you're leaving maybe the US or Canada or other jurisdictions. Upon exit, there's usually a tax associated, like an exit tax on all like of your holdings, right? Securities, property, et cetera. And tokens are part of that. So we find ourselves doing valuations in that instance as well, where people are moving from one jurisdiction to a more tax-friendly jurisdiction. But upon exit, the US or Canada or other areas would potentially say, okay, we have a right to the assets that you are holding, and so we're going to tax it on the way out. So, we find ourselves doing valuations in those instances as well.
Thanks for sharing. Now, I want to go through the topic of M&As in Web3. And at least under US GAAP, the accounting standard for that would be ESC 805 for business combination. So under this standard, it says that the acquiring company must recognize the assets obtained and liabilities assumed at their fair values as of the acquisition date. I want to ask you in Web3, what are some of the unique assets that are part of an acquisition for Web3 business compared to any other, like the more traditional industry?
Yeah, so it's interesting that we're starting to see more activity in the M&A space, no matter kind of what metric you look at in terms of number of deals, number of quality deals, all of that. In the last like 6 months, it's been higher than it's ever been. So we're certainly seeing some attraction on that side of it. And so when those deals are occurring, depending on what kind of project it is, I mean, there are some more like traditional, call it picks and shovels related types of transactions where the companies are more in line with what, Web 2 companies are, but they just service the Web 3 industry. But if I'm looking at like token projects that are being kind of absorbed by other projects or other firms, maybe there's potentially an exchange of tokens or the retirement of certain projects. Either way, the critical thing here is, if I am going to purchase another company in this space, understanding what's being purchased is critical. And a lot of times there's some element of digital asset, right, that is associated with that. And so and we're starting to see a lot of that where, some larger companies are coming in and utilizing their tokens as a method of compensation, right, to make the acquisition from their treasury. And so when you do that, there's like an implied value of the token that is associated with it, but that token may have restrictions or there may be liquidity issues around that token. So in trying to understand what the purchase price of that project is, understanding the token by the issuer is important. And it's similarly in exchange, if I'm looking at what the value of a project is that I'm buying, and maybe it's the reverse, like there's some sort of asset here that in their treasury that from the acquiree that has tokens, and maybe there's kind of an implied value to their token network that's being exchanged in relation to that. And those are things that we have to make sure that we spend time understanding, right, in this process. And then depending on what you're acquiring, like if you're trying to exchange or just a project, the digital assets themselves come into play in terms of their value and recognizing what the purchase price should be. And again, how to allocate, right? Because that's the purchase price allocation, is like, what are the different components of it? And usually the biggest one around that is understanding what the digital asset component of it is. Obviously there's goodwill and intellectual property and all of that, but when you get into the digital asset portion of it, that's where complications can potentially arise. And, given our exposure into the space, we'd have a fair amount of experience doing that.
I'm just thinking about a company preparing for an M&A, and they want to compensate the company they're acquiring in terms of tokens, and then there's like a market swing. Like, how do they protect themselves like from the market conditions?
Excellent point. And we see this quite often. And usually there's provisions in there where, as opposed to kind of focusing in on spot prices of the token, especially if it's traded, right, what you'll do is layer on volume weighted average time periods to protect during the transaction. And so it could be like a 30, 60, 90 day average that you could build into the provisions of the acquisition process, where, that large volatility swing that exists can be somewhat protected by instituting this mechanism to protect that movement when you're trying to figure out kind of the right transaction price. And then you can layer that in with, lockups and provisions there where you try to kind of isolate the value from volatility at the end of the day. But that's probably the most common kind of form of structuring that we see. And we try to recommend to folks when they're dealing with issues where they're buying something where either the issuer has tokens that they're using in the form of compensation, or the acquiree has tokens that you're trying to make an assumption around value and the exchange of value between tokens.
Perfect. Neil, before we speak about Teknos, there's a last topic, and it's an important one. It's about the FASB update on fair value. So ASU 2308, more specifically, for people who would recognize what I'm saying. So now companies like under US GAAP, they have to report their crypto like Bitcoin, ETH at their fair market value. So
Yeah.
and under IFRS, like the standard would be IFRS 13, which is very similar to ASC 820 under US GAAP. So under level 1, it's quite straightforward. When I'm speaking about fair value hierarchy, it's quite straightforward. You would look at observable prices in active markets. But level 2 and 3 can be a bit more complex, especially when you're dealing with less liquid tokens or SAFTs. Can you walk us through some practical examples of what might fall under level 2 or 3, and what kind of valuation documentation would typically be needed to support those positions for their end-of-year financial reporting?
Yeah, there's a tremendous amount of gray area on that space. I think to your point, level 1 is the ETHs and Bitcoins of the world, which there's two. But it also kind of applies to fairly liquid tokens. So I think, Solana and folks like that, the ones that have a substantial amount of depth in the market, there's usually less issues around that if it's in fact just looking at the holdings around that. Now, there may be restrictions associated with those holdings. So even though it's a level 1, the fact that it may be locked up means that there may be discounting mechanisms that you have to take into account on your balance sheet. Also, if those assets are held in the form of some other type of, call it, complex security, if you're holding a bunch of MicroStrategy investments, right, that's a weird kind of call put debt component. And so there may be issues around valuing that from a publicly traded company. But if we put all that aside, then we dive deeper into level 2 and level 3 of assets that maybe aren't on an exchange, but they have value because the token has been minted, it's in the treasury, but now there's been maybe some pricing mechanisms around them. So if there's a SAFT, right, now you've got a pricing mechanism associated with it. And, in terms of marking that up or down, it just kind of depends on how long it's been since that SAFT occurred. What are the components to that SAFT via lockups, et cetera, other restrictions? And then how does that relate to the market in terms of, and we talked about this a little bit before about using a market-driven approach where you're looking at publicly traded, similar assets in the space and how they've moved over time. And then, how that compares to these locked up tokens. There are methodologies there you look at. So when you start talking about level 2, you look at other market components of it to understand the value. Again, and level 2 is a little bit of a gray area. Level 3 is, where there's basically no way to figure it out by way of pricing mechanisms in traditional methods. And then where you can almost default to some of the early stage methodologies like cost-driven approaches, but in all of them, like in terms of support on that. And then we leave this to the auditors to figure out what the level of materiality is, because it just always kind of depends. I'll get 10 different answers from folks on this. But what is clear, though, is once that asset is sitting on your books and you have to recognize it as an investment on your books, being clear about how to mark it up or mark it down is certainly important. And we deal with this quite often with many of our VCs or investment firms, where they have to understand their positions. And if there's pricing mechanisms, even though if they're not public on level 2 or level 3, you can start with that as the data point, but it always has to be adjusted or calibrated, if you will, to the market for that particular asset class. And so we spend a lot of time on that, trying to discern if it should be at call it, the investment value that it came in at, its purchase price, or, has the market moved in such a way that it doesn't make a lot of sense now to still apply that same methodologies. But the exercise still needs to be done. We're seeing that more commonly looked at now than historically, where people just assumed that, well, there's no value to this asset at this point. It's not traded on the exchange. It doesn't really matter. But as we've seen kind of the market evolve, at any point, these assets could have significant value. And if you're getting to a point where the network has a particular amount of traction and exposure, making sure that, someone can't come back later and say, hey, well, I'm not sure if you actually correctly accounted for this under the regs, can be an issue. So those are certain areas of focus for us.
Perfect. Neil, I think it's time to speak about Teknos. So in light of what we've discussed around token valuation, could you provide us with an overview of the services that you provide at Teknos Associates?
Sure. We've talked a lot about several of them during this call, and I think, I break it out into a few different kind of components. There's if we just take the digital asset group in of itself, obviously there's valuing the tokens in of itself for either, call it tax purposes, financial reporting, which we just talked about now, like ASC 820, IFRS 13, and then deal making purposes. And so all three of those kind of work together in different components, but you've got the pre-launch token, early stage type of work. You've got the, call it, post-launch token work that, tends to happen quite often these days with either individuals or the transfer of large blocks of tokens across different jurisdictions. We certainly spend a lot of time on that. So that digital asset part of it on the tax side applies there. And then obviously the IP related work across jurisdictions, things that we spend a lot of time on. Then the other area that we're seeing a lot of work come in is on the transaction side of things. So we talked about M&A, or could be even capital raising, but deal related work where there's transactions amongst entities and the need for almost like traditional investment banking types of services where, we'll work with an investment banker quite often. A lot of us have that background, so we understand how that world works, but usually need an independent valuation for, call it a fairness opinion, where you're trying to justify a transaction to your shareholders when you're involving deals which they may not be at face value, at fair value, if you will, for the transaction. You don't want a shareholder to come back and say, hey, listen, you didn't go through your fiduciary responsibilities in approving this transaction. So when you're dealing with this asset class and you're doing particular types of deals, maybe it's an OTC deal for a large block of tokens between a foundation and a separate entity or an individual. We find ourselves doing a lot of work in that space these days, or for transactions in general. The complications around this are fairly significant as the industry has matured. And so we find a lot of time doing a lot of work there. And then just as these larger projects that we've worked with for years, over the last, I would say 10 years, have evolved with, entities throughout the world, and they're investing in things. They're acting as, they may be a project, but now with their treasury, they're acting potentially like a VC. So they've got projects that sit underneath them. And so they not only need to understand the value of their holdings from an ASC 820 perspective, but each of those projects are going through the same phase of development that they are. And so we find ourselves kind of in the middle of all of this, trying to figure out the best way to help them on the valuation side of things. And then, just because of what we've done over the years, we've built a very substantial network on just the service provider side, the investment side from a VC and angel side of things, and then just an advisory side of things. So, if we don't have the direct knowledge to do something, we have the right partners that we can always team up with folks to do it. So it's kind of the benefit of being one of the first movers in the space, when everyone was scared to touch this stuff in the early days, and now it's very commonplace to some degree. That said, if we think about the overall ecosystem of the financial markets, we're still at like 1% of it, if that, when people think about allocation. So we have a long way to go, but we're excited to be a part of where we're at in the growth thus far.
Can I ask you, how does onboarding look like? Onboarding for a new client, how do you approach understanding the on-chain activities in order to facilitate that valuation process? And what kind of timeline are we looking that could also delay like the token valuation if everything is not provided like upfront?
Yeah. So the good news about what we do is that, given our experience and understanding of the space, we have the ability to move very quickly on these things. I have people who come to me and say, "Hey, we needed this yesterday," and so we can certainly hustle on things. And if we have everything we need, we can move in as quickly as 5 days or even sooner in some instances, depending on what's involved. The standard timeline for, and now I'm speaking broadly for just kind of digital assets in general, under normal circumstances for the pre-launch side of things. Broadly, it's probably a couple of weeks to put something together just to make sure that we're fitting everything in the schedule. But one of the hiccups that often occurs is just not having everything set up with the foundation or the entities in play that are going to distribute the tokens, or making sure that you have the allocation set up or the contracts all set up where everything is going to be custodied. All of that kind of stuff can, because there's three or four, even more sometimes, different moving parts within the organization that you're dealing with in terms of providers that have to work together. And so again, getting back to like our network positivity around who we work with, usually when we come into a deal, we know most of the parties involved so that they can take advantage of our valuation, because our number goes to a lot of different places, right? Because they need that number to facilitate the contracts and do different things. So making sure that you have all parties kind of aligned on this is very important. But it's all contingent upon kind of being able to make the transfers of these tokens or the rights to tokens, and things that hold that up could be anywhere along the lines of we're just not ready to launch the network or mint the tokens. Rather, actually, it's more importantly, like we're just not set up to do that just yet, or there's just been delays in the project. If that happens, then we can issue a draft, but we don't finalize our report until basically a day before they're ready to make those distributions. So it's important that all that aligns. And it's not the end of the world for us. Like we're happy to start and stop because we're used to that process. The only thing, again, you want to be careful of is keeping that distance between what we put together and, again, that pricing of it. Because as you get longer out, sometimes that gets squeezed a bit. All of a sudden we're like, oh, well, the market's great now, I want to launch in 2 weeks. Well, now we have to change the methodology. So, those are things that you want to be careful of. But usually it's, again, getting kind of high level, it's anywhere from 5 days to a couple of weeks is kind of the overall kind of timing on things.
I know you mentioned this earlier, Neil, but just to summarize for the listeners, how would the project work with Teknos if it's something like after like token launch, like for a service after token launch?
Yeah. So particularly if we're on the individual or just a company side where they're dealing with a live token that's in the market, it depends on the nature of what they are receiving, right? Is it a locked token, or is it something that is unrestricted? But in those instances, the starting point is usually kind of where it's trading at on an exchange. And then we, from a valuation perspective, we would take the approach of kind of liquidity around what it takes to move that token through a network. And so in those instances, either it's from a tax perspective for an individual, or you're moving that token to another jurisdiction. In all those instances where you have that kind of transfer of property with a live token, we would make sure that we could justify a significant discount on that value if it's applicable. But that's usually where it comes into play, where you're moving blocks of tokens with some sort of restriction or liquidity issue through either different parties or different entities or different jurisdictions. And depending on what's going on there, we like to be aligned with not only the company and the individual as part of that process, but also their advisors who, legal, tax, et cetera, they come into play to help kind of formulate the position. But certainly it's a lot of work that we find ourselves doing these days, post-launch, just as a lot of these projects mature.
Perfect, Neil. I think it's been quite a comprehensive episode in terms of the topics that we wanted to bring forward. As closing thoughts, has there been anything that maybe we didn't touch on that you'd like to share with the listeners, or how would you summarize the main topic of today, which is around token valuation, token launch and valuation?
Yeah, I think we've been pretty comprehensive around the overall use cases of how we fit into firms. It's constantly evolving, just candidly. What we did 10 years ago has evolved fairly significantly now. I mean, the thing is, we still do a lot of the early stage stuff, but to the point of what I just mentioned before, the complexities around these entities as they mature and start doing different things with their tokens, either from an acquisition or investment perspective, has changed, and we have more data on the markets themselves. But at the same time, just because of the volatility that exists, it does make it a little bit more challenging. And so a firm like ours that has the experience of dealing with all of that and having the history and having really the internal data on things certainly is a benefit to everyone that we've worked with in the space. So we're psyched to be a part of it. We're psyched to see, the regulatory movements, particularly here in the US, move in certain directions where it's far more favorable. Obviously, there's a lot of acts that have come into play, obviously the Genius Act and all of that will make it particularly interesting for exercises that we have to perform, and the legal and the tax world. So, we're psyched to be a part of that at the end of the day. And, I do want to thank you for this opportunity to come on here and talk to these particular issues, because they're not things that are always kind of are top of mind. Like we deal with all these founders and their ideas are focused around kind of building out this project and creating value and contributing to the ecosystem. But these are all some of the boring kind of finance, tax, and accounting things that, that's our job to kind of figure out and help them along the way so they can focus on what they need to do.
Perfect. Well, thanks a lot, Neil, for your time today. So for the listeners, Neil helped me a lot in actually preparing the questions for this episode today. So thanks a lot for your time there. There's a last question, Neil, that I like to ask is, do you have a favorite quote or like a maxim that you live by?
You know what? I don't. And I get asked that quite often, but in this industry, I'm scared to even think about, just proverbs, if you will. So I'm going to leave that alone. But just know that I try to keep my head up and focused at the end of the day.
Perfect. Well, that's a good one that I'll keep. Neil, if people want to reach out to you, or if they want to reach out to you for Teknos or reach out to you on socials, where should they go?
Yeah, I think typically our website's probably the best, just teknosassociates.com. There's ways you'll see our contact information there. Stay tuned. We're actually redesigning that. It's been long overdue, so it'll be very much crypto focused, which we've needed to do for 10 years. But we've been building on other things. But yeah, usually my website is for Teknos Associates. Probably the best way. It has all of our contact information. I'm at NKT_Teknos on Telegram. That's a way to kind of get directly to me as well. So again, appreciate the time. This has been awesome. Thanks so much for having me.
I had a great time. Thanks a lot, Neil. We'll be in touch.
All right.